Right now in the United States, there is roughly 44% more home sellers than buyers. That is changing daily. That number is coming from recent national housing data comparing active listings to pending sales. When you hear that, it sounds dramatic. More sellers than buyers usually makes people think one thing: prices must be about to fall. Before we jump there, let's walk through what the numbers actually say and what they do not. And if you appreciate breakdowns that are grounded in real data instead of emotional headlines, make sure you subscribe now. We're going to keep doing this consistently. Section 1. What the data actually shows. According to a recent Realtor.com housing report, active listings have increased significantly year over year. In many metro areas, inventory is up 20 to 30% compared to this time last year. National inventory is still below pre-2020 levels, but the recovery in listings is real. At the same time, the National Association of Realtors Pending Home Sales Index has been running below historical norms. Pending sales have improved slightly in recent months, but not at the same pace as inventory growth. That gap between listings and contracts is what creates the 44% imbalance being reported. It reflects more homes listed relative to the homes going under contract. That is measurable, but imbalance does not automatically mean distress. It means supply is rising faster than demand is accelerating. Let's get into section 2. Why buyers are not flooding back in. Let's talk about this. Now, let's layer in rates. Freddie Mac's weekly mortgage survey recently showed 30-year fixed rates dropping below 6% during certain weeks. Now, historically, when rates fall meaningfully, mortgage applications will surge. Now, according to Mortgage Bankers Association, that surge has not happened at historical scale. Application volume has remained relatively moderate compared to prior cycles. That tells buyers are still very cautious right now. Home prices remain elevated in many markets. Down payment requirements remain significant, and millions of homeowners are locked into mortgages in the 3 to 4% range from prior years. Now, economists refer to this as the lock-in effect. When mobility slows, transaction volume slows. So inventory can rise while demand remains measurable. That creates negotiation leverage without necessarily creating panic. Let's get into section 3. What this means for prices. This is where most people overreact. More sellers than buyers does not automatically create price collapse. Prices fall sharply when forced selling increases. Right now, delinquency rates remains relatively contained compared to crisis levels from 2008. Most homeowners still have equity cushion. What we are seeing instead of adjustment are more price reductions, more seller concessions, long time on market. Realtor.com data shows the share of listings with price reductions has increased in multiple metros year over year. That is negotiation returning to the market. That is not a systematic breakdown. Section 4, what this means for small investors. Now, if you own a handful of properties or are looking to buy one, this environment can create opportunity. Sellers may be more flexible, terms may be more negotiable, but your underwriting needs to be disciplined. Do not assume rapid appreciation. Focus on cash flow durability. Look at local vacancy data. According to the Census Bureau housing data, rental vacancies have increased modestly in certain regions, but remain below long-term crisis peaks. That suggests moderation, not collapse. Buyer-heavy markets reward operators who are patient and precise. Let's get into section 5. What this means for developers. For developers, absorption is everything. When pending sales trail listing growth, sell-through periods extend. Long sell-through affects financing terms. Lenders watch contract velocity closing. Housing start data from the Census Bureau shows moderation in certain categories of new construction compared to prior peaks. Builders are adjusting to demand signals. Now, that's rational. If you're developing, this is the time to tighten assumptions around absorption, concessions, and timelines. Discipline now will protect the performance later. Now, before I continue, if you're a developer, investor, and you want to see how disciplined operators protect performance in shifting markets like this, I put together a case study that walks through it step by step. You can grab it at corybonner.com/case study. It breaks down how strong operational strategy helps projects perform even when leverage shifts. Now, let's finish this properly. Section 6, what to watch next. If you want to know whether this imbalance widens or stabilizes, watch specific indicators. Watch the National Association of Realtors Pending Home Sales Index. Watch the weekly mortgage application data from the Mortgage Bankers Association. Watch days on market in your local metro. Watch the percentage of listings with price reductions in your area. If pending sales rise while inventory growth slows, the gap is narrowing. If listings continue to climb and contract activity remains very flat, pressure builds. These are measurable signals. They tell you more than the sentiment. Section 7. This is not 2008. Back then, we had widespread over-leveraged lending and systematic distress. Today, underwriting standards are tighter. Equity positions are stronger but narrowing. We are transitioning from an extreme seller's market to something closer to a balanced market. Now, normalization feels uncomfortable because we got used to bidding wars. But normalization is not a collapse. It's a recalibration. So in closing, what does this 44% more sellers and buyers really mean? It means leverage is shifting. It means negotiations matter again. It means disciplined operators have opportunity. It does not automatically mean a crisis. Now, I want to ask you something. In your market right now, are you seeing negotiation power shift meaningfully? Or are well-priced properties still moving quickly? Drop your perspective in the comments. If I'm missing something in your region, I want to hear it. That is how we all stay sharp. And if this kind of data-driven breakdown is helpful, make sure you subscribe. We're going to keep unpacking what actually matters in this market as we see it month to month.